You've probably seen the headlines. Peru just went offline. Another domino has fallen. Supply chains are breaking. Metals are next. And according to some commentary, this is the moment everything finally snaps. When a major resource-producing country hits disruption, it's easy for the narrative to jump straight to crisis. Today, I want to slow this down, separate signal from noise, and look at what Peru offline actually means for precious metals, especially silver, and what it doesn't mean. This channel is financial briefing, and the goal here is clarity, not clicks. Before we dig in, let's ground this discussion in accountability. Back in February, I said that Latin American mining disruptions would likely reappear in 2025 due to permitting backlogs and labor tensions, but that markets would initially underestimate them. Since then, we've seen intermittent shutdowns in Chile and now broader disruptions in Peru. In March, I also said that silver's move above $28 would be driven more by supply-side constraints than investor mania. Silver is now trading in the low 30s, and while sentiment has picked up, the move has been relatively orderly. And in early May, I cautioned that not every headline about offline production translates into immediate price spikes. That framework applies again here. Let's start with the first hard data point. Peru accounts for roughly 10% of global silver production, producing about 3,400 metric tons annually, or roughly 110 million ounces. Recent reports suggest that up to 20% of Peru's mining output is temporarily disrupted due to a combination of power grid instability, port delays, and localized labor actions. Historically, Peru has faced disruptions before. In 2022, nationwide protests reduced mining output by nearly 15% for several months. What this means is that Peru, going partially offline, is not unprecedented, and the global system has absorbed similar shocks before. What it does mean is that incremental supply just got tighter, especially for refined silver used in industrial applications. What it does not mean is that global silver supply has suddenly collapsed. Even a 20% disruption in Peru translates to about 2% of global annual supply. The second data point is concentrate export flow. Peru exports a significant portion of its silver as polymetallic concentrate, often alongside copper, zinc, and lead. Port congestion and customs delays have reportedly slowed exports by roughly 10 to 15% over the past month. In historical context, similar slowdowns occurred during COVID-related disruptions in 2020. At that time, physical silver premiums rose, but spot prices initially fell before recovering later. What this means is that downstream refiners may face short-term feedstock tightness, which can push up local premiums. What it does not mean is that futures markets immediately reflect that stress. Futures price discovery often lags physical bottlenecks unless they persist. The third data point is silver inventory drawdowns outside of Peru. Global visible inventories, including London and COMEX, are already lower than their 5-year averages. Combined, these inventories are down roughly 12% from 2021 highs. When a producing country like Peru experiences disruption against that backdrop, the system has less flexibility. What this means is that supply shocks matter more when inventories are already thin. What it doesn't mean is that there's no silver left. There is still ample above-ground stock, but it's increasingly price-sensitive. Now, let's walk through the bullish case. First, Peru's disruptions could last longer than expected. If power and logistics issues persist into the next quarter, refined silver supply tightens further. Second, industrial demand remains resilient. Even with slowing global growth, solar installations and electrification projects continue to consume more silver per unit. Third, higher prices discourage forward selling by miners, tightening near-term supply. And fourth, silver tends to react with a lag. If gold holds above 2,300 and macro uncertainty persists, silver could play catch-up. In that scenario, a move toward $36 to $38 over the next 6 to 9 months is plausible. I assign that outcome about a 30% probability. Now the bear case. First, Peru's disruptions may be shorter lived than headlines suggest. Mining companies have strong incentives to restore output quickly. Second, higher prices stimulate scrap supply. At $32 to $34 silver, recycling flows increase meaningfully within weeks. Third, demand elasticity matters. Industrial users can defer or thrift silver usage when prices spike. And fourth, speculative positioning has already increased. Futures longs are no longer light. In this scenario, silver stalls in the low 30s and drifts back toward 28. I give that about a 30% probability as well. That leaves the middle case, which is where I'm anchored. Peru's situation improves gradually, but not immediately. Some supply is lost, but it's partially offset by scrap and inventory drawdowns. Silver remains supported above 28, but upside is capped unless macro conditions deteriorate sharply. The result is a wide but constructive range between $29 and $35. That's a 40% probability in my view, and the scenario I'm positioning for. For historical context, the closest comparison is probably the 2006 to 2007 period. Back then, supply disruptions in South America coincided with rising industrial demand and tightening inventories. Silver prices rose steadily, not explosively. The similarity is the slow burn nature of supply stress. The difference is financialization. Today's markets react faster, but they also fade narratives faster. That cuts both ways. Looking across markets helps ground this. Gold remains firm, suggesting ongoing demand for hard assets. The dollar index is range-bound, not collapsing, which limits runaway commodity inflation. The 10-year yield remains elevated but stable, signaling tight financial conditions, but not panic. Together, this backdrop supports real assets, but it doesn't confirm a crisis regime. That aligns with the middle case outlook. Positioning data reinforces caution. TOT reports show managed money net long silver, but not at extremes. Commercial hedgers have increased short slightly, typical at higher prices. Banks appear hedged, not aggressively bearish or bullish. This is not the setup for an imminent squeeze, but it's also not complacent. So here's my action plan. If silver breaks above 36 on sustained volume and Peru-related disruptions persist, I add modestly. If silver falls below 28, I reduce exposure. Currently, my allocation is about 7% physical silver, 3% silver equities, and no leverage. My stop loss on trading positions is 27.50. My first take profit zone is around 38. This is not advice, just my framework. What I'm not doing is panic buying because a country went offline. I'm not assuming every disruption is a domino to collapse. And I'm not consuming fear-driven content that frames complexity as inevitability. This week, I'm watching three things closely. First, updates from Peruvian mining authorities on power and port restoration. Bullish if delays extend, bearish if resolved quickly. Second, silver release rates and physical premiums. Bullish if they remain elevated, bearish if they normalize. Third, gold's behavior around 2400. Bullish if it holds, bearish if it fails. Let's wrap this up. Peru's disruption matters, but context matters more. Supply is tighter, but not broken. Silver is supported, but not guaranteed a breakout. Stay analytical, stay disciplined, and don't outsource your thinking to headlines. If you value calm, data-driven analysis, consider subscribing. This is Financial Briefing. Stay sharp.